And welcome everybody to another episode of Smart Money Circle. I'm Adam Sarhan, your host. My guest today is Carl H. Scholtz, CFA and Portfolio Manager at Scholtz Company, with approximately $250 million in assets under management. I'm looking forward to today's show. Carl shares his investment strategy with you, some timeless lessons he's learned from Yale to Wall Street, and he's a fifth-generation investor. So without further ado, Carl, welcome to the show.
Well, thanks for having me on. This is my first podcast, so I'm certainly excited to do it.
I'm sure you can do a great job. Carl, I always like to start by asking if you can tell us your story and how you got involved in this business.
Yeah, I think, in terms of my story, it probably makes sense to do a pretty brief family history. Finance has really been a common thread for my family through the generations. The firm I work at now is actually the second Scholtz Company. The first one was started by my great-grandfather in 1905. And, they were a coffee and coca dealer based on Wall Street. And I think at one point they were the largest coffee importer in the country.
Oh, wow.
He ran the firm, and then two more generations ran it until it was eventually sold in the 1980s to Cargill. Nice. So, the current version is sort of Scholtz Company 2.0. Mm-hmm. And, my father started it in 1994. We just had our 25th year anniversary. Woohoo!
Congratulations. That's awesome.
Only we're not coffee and coca dealers. We are focused on the management of investments for individuals. And so I guess that's sort of a roundabout way of saying this is really a family run and owned business. And I've been around this stuff my whole life. I'm the kid who's 4 or 5 years old, and his father's showing him cool stock charts and having him watch Wall Street Week with Louis Rukeyser.
Nice, nice.
So I've definitely been around it, a lot. Just in terms of my personal background, I graduated in 2003 from Georgetown, and then I worked at Deloitte for a couple years. And at that point, I was thinking about going to business school. And both my father and I decided it would make a lot of sense for me to, try my hand at Scholtz Company for a little bit, just to see if we could work together. It was kind of a big experiment. And so I had my first tour of duty with Scholtz Company in the 2005-2006 time frame. And then I went to Yale for a couple years. And after graduating there, I worked at a mutual fund company called First Investors, covering healthcare and consumer staples stocks, before finally returning to the mothership in 2012. And now I'm a portfolio manager, and can't be any more excited about what I'm doing.
Oh, I love that. So just to clarify for the audience, when you say you manage money for investors, or do you manage in equities, or you do fixed income, or do you still do coffee and cocoa like you did before?
Yeah. So we're fairly traditional and vanilla. I would say we are becoming more and more unusual in this day and age, and compared to many of the other registered investment advisors, in that we are first and foremost focused on investing. A lot of other RIAs are outsourcing money management via ETFs and mutual funds, whereas we're spending all of our time picking individual stocks and bonds, which we put in customized accounts. And I say we're vanilla because we're not doing exotic options or futures or anything like that. It's mostly stocks and bonds. But what makes us unique, or maybe gives us the ability to do that in this day and age, is unlike a lot of other RIAs, we have in-house full-time analysts who can spend 24/7, 365 researching and searching for new investment ideas. And combined with the portfolio managers, that's really what makes up the investment team, and how we feel like we can continue to pick stocks in this day and age, rather than, as I said, outsourcing the money management piece of it. We are focused certainly on investing. We do help with financial planning as well, but that's not really our primary value proposition. My father likes to use what he calls the wagon master analogy, and what that is he says, imagine it's 1850 and you're living in Philadelphia, and the gold rush is happening, so you really want to get to California. The financial plan is the covered wagon, the oxen, the supplies. You have the plans, the means to get to the West Coast. But there's going to be a lot of pitfalls along the way, and it certainly is not an autopilot kind of situation. So we are more of the wagon masters. We're the ones who are going to go with you across the country, and really guide you through your journey. The only other thing I'd mention is, just in terms of our client base, our typical client has, maybe around $1 million with us. So we say high net worth individuals, are our focus, but it really runs the gambit. We have a lot of clients who, really live off this money in retirement and really look to us to, protect them and make sure that their lifestyle is what they expect.
Well, that's perfect. So that's a good segue for my next question. If you can elaborate, please, and tell us a little about your investment strategy and how you guys play the game.
Yeah. So, I think if you go back through the firm's history, when my father first started out in 1994, we were very small. It was just him and an assistant in an office. And, for him, he wasn't able to spend 40 hours, of work on each individual idea. So what he did at the time was develop, quant models, which helped him screen for stocks. And then he would do some level of fundamental analysis from there, and that's how he would pick his securities. However, the one thing you learn in this world is you always need to evolve and adapt, right, to the changing times and changing investment strategies of others. So, and for us, that means a couple things. One, we've sort of gotten to a size where we've been able to, hire in-house, analysts. So we have more research muscle. But the other thing is, the quant world has gotten so sophisticated that it's frankly no longer really our niche. So what we've done is we've gone more retro in that we've kind of redoubled our efforts in terms of, doing deep investigative fundamental stock work, building Excel models, talking with management, doing channel checks, and also, we've taken a longer time horizon because, a lot of the quants, and really the investment world in general, they are focused on, what's going to happen this year or maybe next year. They're looking at changes in sell side estimates. But, what we're trying to do is look at, okay, how is this company going to look maybe 3 to 5 years down the road? And, we think that that's still an area where there's a lot of market inefficiency. Obviously, it's very hard to figure out what's going to happen 3 to 5 years down the road, and that's why we spend so much time on each of our ideas. I think we often get the question, how do we find our stock ideas? And, I think what the question's really asking is, what's your process where you do XYZ and out pops ABC stock? And, my view is there are no magic formulas, in this, game where you can treat it like that. It's more about knowing a good stock when you see it. So we are going to search high and low through a variety of means for any, good investment ideas. And, we just need to be able to recognize a good idea when we see it. The analogy I like to use is, when I was a kid, I would go to the beach and I would be looking for crabs. And, to do that, you just turn over rock after rock after rock until you eventually find a crab. So that's kind of what we're doing here. We're turning over rocks everywhere. And, what we think is unique about our process is, we feel very comfortable in understanding what a good investment looks like. So, we've developed sort of a systematic process for that, which we call the framework. Okay. And the framework is really how we define or what parameters we use to define one of these companies that we want to invest in. And we call them 5-star companies because they have really 5 winning characteristics, okay, which, I'll rattle off for you. They're gaining market share. They operate in a secular growth end market. They have high barriers to entry. They are in high return, high margin businesses, and they're run by a good management team. And, ultimately what those characteristics allow you to do for the company is to compound capital at a very high rate for a very long period of time. And the other thing I'll say is, those are all obviously kind of positive attributes you'd want to have. I mean, which one of those would you not want to have in a company? But, the tricky part is finding companies like that who you also can stomach the valuation, so to speak. Because, really what we're looking for is wonderful businesses at fair prices rather than fair businesses at wonderful prices.
Right.
And so, part of our process is we build out a list of these companies and we're just watching them, waiting for an opportunity to get into them. Mm-hmm. Maybe they have an investment year and the stock, misses some estimates and has a weak, performance for the year. And that's what creates the opportunity because all those 5 characteristics are still in place.
Got it.
So that's pretty much, how we think about it, in terms of, stock selection.
I love that. So, more of a fundamental orientation to you. Do you guys you mentioned when you were a kid, you looked at stock charts. Do you guys use technicals at all in the analysis or entries?
We do, but I would say, the vast majority of our work is fundamentally driven. I mean, we'll look at technicals for entry and exit points usually. Mm-hmm. So when we've found one of these companies that's kind of down and out, we don't always just buy it. We kind of wait for the charts to maybe tell us that the pain is over.
Right.
Because sometimes these companies will linger for months and months on end.
Right.
Conversely, we do spend a lot of time trying to figure out, well, what is this company really worth? And when it goes well above fair value and we feel like there might be a reason to exit, i.e. the thesis might be eroding a little bit, we're not going to sell it if it's on the dead run higher. So once again, we'll sort of wait for some technical, indicators to tell us that it's time to exit. But that's a very small part of what we're doing here, the technical analysis. It's really fundamentally driven.
Understood. So the next question, Carl, is how do you handle risk and what mistakes do you see people make with respect to risk management?
Well, in terms of how we handle risk, I think it's important to kind of put it in 2 buckets, and because we're managing individual accounts for our clients, there's a client side to this, and for us, we really want to make sure that we've sort of appropriately placed each client in a risk bucket, so to speak, and really made sure that their portfolio matches up with their unique circumstances. So that's really the first line of defense. I mean, yeah, it's great if we're brilliant and we get out of the market before it goes down a lot, but that's hard to repeat. But if we're already in the right spot before the storm starts, that goes a long way. And I think the important point with that also is you can't just look at an individual's circumstances in a vacuum. You have to understand the personality as well, because if you're a single person who's 35 years old and making $300,000, in theory you don't need the money and you have a long time till retirement. In theory, you could be quite aggressive with your investments. But if at the same time your personality doesn't match up with taking on much risk, you really would be doing them a disservice, because they might lose a little bit of money, panic out of the market, never want to go back, and then they've just lost 30 years of compounding their savings.
Right.
So I think that's kind of the first piece of it. On the second piece, of course, is the investment process itself, and there's sort of the portfolio construction piece, which is we spend a lot of time trying to understand how the portfolios are constructed, looking at the volatility of the names within the portfolio, the sector allocation, the asset allocation. I think we hold probably, up to about 40 different equity positions in most accounts. A large position, we might start off with maybe 3.5 or 4% of the capital put to work, whereas a riskier name might only be like 1.5%. And then, of course, there's also well, what do you do, as the market's changing, and how do you manage risk that way? So on a macro level, we have developed an in-house, what we call the dashboard, which is a bunch of different indicators just to tell us kind of where we are in the cycle. And it's not market timing per se, and that it's, oh, well, we're going to be out of the market this month and get back all in the next month. It's more general than that. And what it's trying to tell us is, are we in the third inning of the economic cycle or the eighth or ninth inning? And as we progress through the game, we want to slowly dial back the risk, move more towards defensive securities like bonds. And, that certainly has treated us well over the last few decades.
That's fantastic. So you basically look at risk based on each individual account, and then you look at where we are in the cycle and adjust accordingly and make sure that you're giving each client their appropriate risk that's they can tolerate or that's palatable for them, opposed to just having a one size fits all.
It's all customized. So we're really trying to, we're not trying to put anyone in any boxes, and that's one of the things I didn't mention. We are our equity investments we define as all cap core, which means we're not choosing growth or value or market cap size or anything like that, because what we're really trying to do for our clients is find the optimal risk reward ratio for them in any individual security, and we don't want to pigeonhole ourselves that it has to be value or it has to be growth. We think that doesn't make a lot of sense to put, I know Wall Street's put everything in these style boxes, but we've always wondered the wisdom of that, because if you see a great investment in different style boxes, does that mean you're not going to make it?
Yeah, exactly. I get your point. So how about individual stocks? How do you handle risk for your holdings? Let's say it's a 5-star stock. You buy it, technicals turned around, it bottomed, whatever the case may be, and now it's going higher, things are good, and then all of a sudden the fundamentals are good, but it starts rolling over again, whether it's due to individual stock action or sector action or the overall market. Can you speak to that a little bit, please?
Yeah. So, the scenario you laid out sounds like kind of a high class problem. You have a winner and it's starting to roll over. I think, because we're taking this longer term time horizon, ideally we are not going to sell a stock just because there's sort of short term, poor technicals or anything. We're focused more on, okay, what is the fundamental thesis? And, does it check the framework boxes? And if nothing's changed, we're far less likely to want to sell it. Now, the flip side of that is we don't want to be stubborn and just watch this thing ride, down 30 or 40% either. So, as the stock declines maybe 15 or 20%, especially from our original cost basis, we're going to take a very hard look at that. Okay, what are we getting wrong? Why is it going down? Is it rational? But we're trying not to be too short-term oriented here, because that, I think, gets a lot of investors in trouble, trying to trade in and out, in and out, in and out. And, all these stocks have, normal oscillations, and nothing's changed.
Yeah.
So, ultimately, we're not really buying stocks, we're buying companies. And if the companies continue to progress in the direction we expect and hope, then, there's no reason to sell it. But yeah, I mean, at a point, you just have to admit you're wrong and, get out. And, sometimes that happens. But, fortunately, it's less often.
Understood. Okay, cool. So I guess the next question I have for you, what are some well, before I go there, what about some mistakes people make with respect to risk management that you see happen? Is it just not being aligned with your own comfort zone, or is it other things that you can speak to?
Well, in terms of mistakes that I see with risk management, I do think that, just in general, we're all human. We have a lot of behavioral biases, and I think sometimes people get caught up in the moment. I mean, risk management goes both ways. I mean, if you're buying stocks as they're, streaking to new highs, you're also probably taking on too much risk. And if you're selling a stock just because it's down a little bit and not working, you might be, losing a good opportunity. So I think, what I see in terms of mistakes of risk management is just a lot of people succumbing to, sort of natural biases and behavioral tendencies. The classic thing that, there's a lot of literature written about is, when, or should I say studies done about is, when people are down, whether they're at a casino or in the stock market or something, they're more likely to increase their bets.
Yeah.
So, that would be, throwing good money after bad, so to speak. So you have a losing position and you want to make up for it by putting more money in that position, and hopefully it will turn around. Now, sometimes that can make sense, but I think that people are more apt to lock in a profit after they've made 10% when the stock might be ready to go up fourfold over the next several years. And when the stock's down 20%, they want to triple their bet.
Got it. So it's more along the lines of just that human behavior element, which is just so critical in both life and markets.
Yeah.
Got it. So next question for you, Carl. What are some timeless lessons you've learned along the way that you'd like to share?
So, I think one of the ones that's really resonated with me over the years that Peter Lynch made, this concept famous, I think, was, invest in what you know. And for me, for him at least, the example was, you go to the mall, the Foot Locker store or something, and you understand it and you're comfortable investing in it. But I think it's more just beyond that. It's kind of stick with your sort of sphere of knowledge, so to speak. Yeah. And, the example that comes to mind for me is that, we had a portfolio manager who joined us, I think this was 7 or 8 years ago, and he stayed with us for a few years until he retired. And when he first joined, and he had spent a ton of time overseas, he was sort of shocked that we weren't invested in more international companies. Mm-hmm. And, for us, we had a lot of hesitation in doing that because, you've got to know the political scene and the unique country's macro environment and the regulatory situation, and the accounting might be different and the legal system's different. So it's really complicated. And, when something goes wrong there, we're over in the U.S., we're in a different time zone, we're going to be the last people to know. So we didn't feel as comfortable investing in that space. He did, because he had spent so much time in some of these areas. And so I think the point is that every stock, is not right for every investor. And if you don't invest in what you know or within your sphere of knowledge, when something goes wrong, you're not going to be able to react properly. You're going to be behind on the information. The other investors, out there are going to have a much better understanding of, okay, the stock's down 5%. Is this a buying opportunity or should we be panicking out of it? I think that's a very important lesson to follow. Some of the other things that, sort of timeless lessons that I certainly take to heart is I really like to, develop a strategy ahead of time. And what I mean by that is, if a stock gets down to a level, I've already predetermined that I'm going to buy it there, provided nothing's changed.
Right.
And, act on that. Because usually what happens is a stock goes down, everyone watches XYZ stock go up month after month, and they say to themselves, well, I can't wait for that moment when there's finally a pullback, and then I'm going to buy. And then a pullback happens, and they don't want to buy because they think, oh, something's wrong, or right, it doesn't look as fun because now it's down 10%, and you're just happy you don't own it.
Yeah.
And I think if you've sort of, and write it down. I mean, if you've written down, okay, if this stock is gonna come down to this level, I'm going to buy it. And you do, I think a lot of times that will treat you well, because once again, back to these behavioral biases, you're sort of overcoming that by making the decision ahead of time.
Yeah, that's a really, really good point. So Next question I'd like to ask are, what are some timeless mistakes that you see people make in the market or with their money, not just with risk management, but just overall mistakes, and how to avoid them?
Yeah. So, I think one of the examples that really hits home for me now, and I'll tell you why in a minute, is this idea of, some people, they get really excited about, a business opportunity or something because they realize the demand is going to be really big.
Right.
And what's failing to understand is whether it's actually going to be a good business to be in. And sort of the classic example of that to me is the personal computer industry, which if you roll back the tape, 35, 40 years, it's going to be huge. And frankly, it was. I mean, almost everyone has a personal computer, but there might have been moments where, some of these companies like Apple or, IBM or Dell had a nice run, but what ultimately happened in that industry is it became very commoditized, cutthroat, low margin business. And it wasn't a good business. So it wasn't really a good investment opportunity, even though the demand was huge. The good investment opportunity was Microsoft. I mean, the software side of it, where you did have barriers to entry that hasn't been commoditized, that's been a good business. The example I think of now, which is screaming this, is the marijuana industry.
Right.
So, everyone thought or has been thinking, well, marijuana is going to be huge when they legalize it. They've legalized it recreationally in Canada, and eventually maybe it'll be legalized nationally in the U.S. It's going to be huge. So, all of these stocks, if you go back a couple of years, had huge runs. They were up 4 or 5-fold. And, at least this year or recently, they've been crashing. I mean, I think they're down 80 or 90%, most of them. And what has happened is there's no barriers to entry, and everyone was able to raise capital. Everyone could get a license from Canada to grow the stuff. And you don't even need that much farmland or space to do it. So we have massive oversupply, prices are coming down, and these things are collapsing. So while, yes, marijuana demand is going to be big, it's not a good business to grow it.
Right.
It's like, wheat is big, but everyone, has wheat, but no one's dying to invest in a wheat farmer because it's just a commodity business and it's not a high return, high margin business that you want to be in.
Right.
So that's definitely one of the bigger mistakes I see.
That's a very good point too. It's not just look at the demand on the surface, but dig deep and understand the numbers to make sure that it's actually profitable and sustainable, and earnings grow and cash flow and all that other fun stuff. That's a really good point. So,
I mean, some of the.
Yep. Sorry. Go ahead.
Well, I thought of another one that I think is
shoot. Yeah, go for it.
Certainly harped on by Kramer often, which is sort of this mismatch of time horizon. So. We see a lot of investors who have kind of a long-term thesis, but they'll trade a security short-term. And his always example is, Apple, he says,
right,
own it, don't trade it.
Yeah.
And, I think, there is a lot of human nature to, try and be what we say too cute. You think the stock might go down 3%, so you sell it.
Yeah.
Even though you think it might go up 100% 3 years out. And that's being too cute. Just take the 3% down move and stick for the long term, because most of the time what happens is you sell it, it might even go down 3% and then you don't get back in.
Yeah.
And you've missed it. And so, the last thing I'll just mention about mistakes is, I certainly make them, because this is a very humbling business. And what I try and do is, every year I kind of do a journal of what mistakes I made during the year that I want to not make in the future. And so I've been building that for years now. And what I also do is every quarter I go back and review it.
I love that.
So, trying to cut down on the mistakes goes a long way in this business. And there's a lot of potential mistakes to be made.
Yeah, that's actually, I do something very similar. I learned it from somebody who goes, it's a yellow brick road where you want to get to Oz, and you just have to figure out how to trim those mistakes down, because the winners will take care of themselves, but constantly work on yourself. Just curious, Carl, what would be like one of those mistakes that you've identified that you've been able to get rid of or help reduce because of your analysis? Or teaching?
Let's see. Well, certainly one that I can think of right off the bat is um, if you're gonna panic early. That's kind of maybe that's a
I
timeless
love
lesson,
that.
but
That's
like
great. That's
you
great.
know, if some company comes out with earnings and it's negative, and it's changing the thesis, so we no longer consider them a framework company or something along those lines, and we want to get out. We've found that if you sell it in the first 30 seconds or minute or even in the pre-market, usually that's the right decision.
Right. Understood. Yeah, I love that. That's a really, really, really good point too. Because otherwise, what's the point? If you're going to panic, you might. If you're going to do it, then do
Yeah,
it
I
early.
mean,
Right?
hopefully we're not doing a lot of that, and we
Exactly.
don't. But it's certainly one where we've said, okay, we want to something bad happened. We want to sell this stock, and we've thought of, okay, well, should we sell some at the beginning, then some later? Should we hold off for the inevitable bounce? And one of the many lessons we've learned is that just panic early, just sell it all right away and move on.
I love it.
But you got to make sure you're making the right decision to do that, because once again, if the thesis is not damaged and it's just a temporary blip, that's probably a buying opportunity.
Understood. Yeah, that's a really, really good distinction. So I guess, Carl, to wrap up here, what's the best piece of advice you'd like to share with the audience?
Well, the one that I often go back to is sort of a classic, which is, if you're passionate about what you do, you'll never work a day in your life. And I really feel like I live that. I wake up and I'm kind of excited to go to work. My wife says I just want to, get away from our 4 young kids and get a break. But, I love this job. I'm very competitive, and investing in markets is certainly that. But, there's also a human element here. And I feel like we really help a lot of our clients who certainly need it. So that would definitely be the main one I would give. The other one, which is maybe not as classic, when I first started at Deloitte, I think after the first month or so, my boss took me out to lunch, and I was always a hard worker, but he felt like I was kind of relying on others to maybe complete the project or really cross all the T's and dot the I's. And what he told me was, really take ownership for everything you work on. Make it your own. Even if you're working in a team, make sure they're doing their jobs well. And if you take ownership and care about the project you're working on, or whatever it is in life, really, it's just going to come out that much better. Yeah. And I've certainly carried that through my career, and I think it's treated me very well.
I love that. So passion and caring, it's fantastic. So, Carl, what's the best way for people to get in touch with you?
Well, there's multiple avenues in this day and age.
Yeah.
They can certainly call me. It's 203-714-9900. My email address maybe is a better avenue. That's cscholtz@scholtzandco.com. We have a website, scholtzandco.com, and I'm on LinkedIn as well. So one of those avenues is probably achievable.
I love it. Well, Carl, thank you very much for being on the show. It's been a pleasure, and hopefully we'll talk again soon.
Well, thank you so much for having me on. I've certainly listened to some of your prior episodes, and I think you're really providing a lot of value to both non-professional investors, but also professional ones, because I'm always trying to improve and get better at what I do as well, and it's certainly helpful to hear how other people think about the investing world, and that just only makes me that much better at what I'm doing.
Well, thank you very much for the kind words. It's very kind of you. That's the whole point of the show, is just to get timeless educational advice and learn from some of the smart money out there. That's the big guys that manage money for a living and do this day in and day out. So thank you kindly.
Well, we're all always learning.
And that's it. That's the name of the game. Well, thanks, Carl. We'll talk again soon. It's been a pleasure.
All right. Thank you so much.